A pioneer in public finance since 1955, Ellers helps clients build outstanding places to live, work, learn, and play by delivering focused, fully integrated financial advisory services. We work with more than 1,500 local governments, schools, development authorities, and public agencies, placing their needs and best interests at the heart of everything we do. We help our clients navigate all facets of public finance, including financial management planning, economic development and redevelopment, debt issuance and management, investments and treasury management, and arbitrage consulting. At Ellers, we believe strong communities aren't simply the result of transactions. They're the result of people. We build strong, long-lasting client relationships, collaborating with your staff to complete projects and drive new initiatives forward. Building strong, vibrant, and sustainable communities. Together, it's what we do. For more information, call us at 1-800-552-1171 or visit ellers-inc.com.
Good morning, everyone. Thank you for joining us for Ellers' virtual session to discuss the nuts and bolts of financing. My name is Greg Johnson, a Senior Municipal Advisor here at Ellers, and I'll be serving as your moderator today. Before I introduce my colleagues and we get started, I just have 3 quick housekeeping items to mention that will help ensure you have a good interactive experience with us today. You'll notice in the upper right-hand corner of your screen, there are 2 icons. One is called Live Q&A, and the other is Chat. As we move through today's presentation, if you have a question you'd like us to answer, simply open the Q&A tab, type it in, and submit it. We'll take a few breaks during our time together to answer the questions you've submitted. You can also have conversations throughout the session with fellow attendees by opening the chat function. One thing to note, while you can submit any question anonymously, in the event we're not able to get to all the questions today, we recommend you allow us to see your information so we can reach out to you directly with specific answers and other follow-up items. Lastly, if at any point during our presentation you start to notice either video or audio lag, please go ahead and refresh your browser, and that will get you right back on track. Now that we've covered the housekeeping items and we have those out of the way, let's go ahead and get started. I'd like to introduce my colleagues that will be presenting to you this afternoon. First is Jonathan Schatz, a financial specialist. Also Brian Riley, a Senior Municipal Advisor. Stephen Broden, our Arbitrage Managing Director. And Sarah Beecher, our Public Finance Manager with Ellers. Jonathan, you're up first. Welcome in. Take it away.
Great. Thanks, Greg. And thanks, everybody, for being here this morning to talk about bond basics and the nuts and bolts of public financing. First off, I want to talk about our agenda for today. So I'm going to talk about some key concepts and key terms around public finance, and then turn it over to my colleague, Brian Riley, who's going to cover market players and issuance processes. And then we're going to finish up with Steve, who's going to cover arbitrage, and Sarah, who's going to cover continuing disclosure. So let's start off by asking the obvious question. Why do Wisconsin governments borrow money? And the answer, by nature, Wisconsin governments are partly a collection of assets, be that buildings, facilities of other sorts, infrastructure, streets, utilities, IT infrastructure, equipment, machinery, all sorts of assets. And those assets have a cost of acquisition and a cost of maintenance. And oftentimes that cost can be prohibitive for cash financing. So borrowing is a good tool to use in those situations. We're going to look at 3 types of capital financing for municipalities first. The first one here is pay-as-you-go. So pay-as-you-go is essentially using your operating levy, building cash reserves to pay for capital projects, which is efficient for short-lived assets that quickly depreciate and have a high turnover rate. However, it can be difficult to save up enough money over time to pay for some of those higher cost asset or projects like buildings and streets. Therefore, this can be cost prohibitive. Also, with levy limits, it can be a challenge to fit that savings within allowable levies. And then there's the issue of generational equity. So the idea that the cost of an asset should be spread out over the consumption of that asset, and this is an inefficient way to do so. The next type of capital financing would be internal fund loans. So a typical example of this would be a utility fund lending to a general fund to do a capital project, or a general fund lending to a TID to advance funds for upfront costs or to get the TID off the ground. Our advice for this is that we should be always charging a reasonable rate of interest for this, since there is an opportunity cost associated with using cash for lending instead of other things. And also to make sure that you're always keeping track of liquidity concerns, since you're typically using cash that might be otherwise reserve funds, and making sure that the cash is not going to be using that cash was not going to be detrimental to that fund. The third type of municipal capital financing is debt, and debt can raise some eyebrows, of course, but we, in the context of this presentation, are going to talk about it as a tool for financing capital projects that allows you to preserve cash and resources in your municipality. It also allows you to accomplish that efficiency of paying for the cost of an asset as it is being consumed over its useful life. Therefore, those who are benefiting from it are also paying for it in an equitable way. Debt also allows municipalities to manage and stabilize tax rates, since you can structure it in certain ways and allow yourself some flexibility to project out debt service long term. And some debt is exempt from levy limitations, so it's a solution to that as well. Now we're going to talk about three types of security provisions for debt in Wisconsin. The first one is general obligation debt, which is debt that is backed by the taxing authority of the municipality. Wisconsin state statutes limits general obligation debt to 5% of the municipality's equalized value, and requires that debt is fully retired no later than 20 years from its original issue date. Most GO debt is exempt from municipal levy limits, so it is attractive in terms of getting around levy limits and being able to build in flexibility for operational budgets. It usually comes in two forms: GO promissory notes and GO bonds. So we'll take a little bit of a look at either or both of those options. So GO promissory notes are issued for nearly any municipal purpose, which gives them a significant amount of flexibility for municipalities to spend. One requirement is that the stated maturity date is no later than 10 years from the original issue date. However, GO notes can be issued with the intent that they would be refinanced within that 10-year limit. However, it must be the refinanced debt must also be paid off within 20 years. General obligation bonds can be issued for up to 20 years from the original issue date, but they must be issued for a specific authorized purpose under state statute, and the governing body must adopt a resolution that they intend to issue these bonds for that specified purpose. GO bonds may also be subject to a petition and reverse referendum, so there is some issuance risk associated with them. And bonds that are issued for 20-year, or GO bonds that are issued for new money purposes, like a construction bond, have a requirement in Wisconsin that they're sold using a competitive process. The next type of obligation we're going to look at is a revenue obligation, which is debt that is backed by revenues from a publicly owned enterprise. So the typical examples here would be water revenues, sewer revenues, electric revenues, nursing home, housing, marinas, parking revenues. All of those revenues can be pledged to back debt issuances. And even tax increment financing can be pledged, or tax increment can be pledged to finance capital projects. There's no dollar limit for this type of obligation. It can be a small issue or a large issue. And the stated maturity can go no later than 40 years. So there's a longer potential term for revenue obligations compared to general obligations. Levy limits, allowable levies can be adjusted to accommodate revenue for insufficient revenues to make debt payments. So there is some flexibility with the levy limit worksheet to back a revenue obligation. The next type of obligation we're going to look at, and the last one, is an appropriation obligation, which is subject to a governing body appropriating revenue every year to pay debt service on that obligation. Therefore, this type of obligation is risky in that it requires a governing body to essentially budget revenue each year in order to make those principal and interest payments. It's the typical use for an appropriation obligation would be a CDA or RDA lease revenue bond. And I think, one of the advantages there is that this is not subject to the GEO debt capacity requirements. However, it is typically subject to levy limits. And just a note on this, always consider where revenues supporting an appropriation are coming from. Typically, those lease revenues are coming from a net operating income of some entity. And so it's always important to consider that when you're looking at that type of an obligation. Now we're going to shift gear a little bit and talk about some key terms related to public finance. First off, this slide just shows 4 terms: bonds, notes, securities, or obligations. And we just wanted to show that all of these are acceptable and interchangeable terms to use generally for debt. You can say any of these and we'll totally understand what you're talking about. Maturity is, among other things, what we were lacking when we were younger, but also refers to the date at which the final principal payment on a debt issue is made. I think one clarification that I'll touch on briefly here is that for open market municipal securities, it's possible to have a maturity every single year. That's what we call a serial bond. And so when you look at, say, a final official statement and you see the pricing on the bond, you would see that each year has its own maturity date and interest rate. That's just the type of structure that the underwriter wanted. There's also a way to have several years mature at one time, and that's called a term bond. That's a topic mostly better saved for more a 201 type of presentation, but wanted to at least touch on that since it can be confusing. Par is the face value or principal amount of a debt issue. So it's not just the construction costs or the equipment costs. It also includes cost of issuance, and it also nets out any investment income or transfer some other funds that may be planned to reduce the debt issue. So it's the total principal amount net of any offsets. So the next set of terms we're going to look at are related to interest rates for open market securities. So coupon is the stated interest rate on a debt issue. So when you get your final loan documents and it says what the interest rate that you're going to pay every year is, that's your coupon rate. And that's true for both fixed or variable rate obligations. Yield is kind of conversely is the rate of return for an investor who purchases the security. So if you kind of think of it as two sides, the coupon is what the issuer is paying in interest, and the yield is what the investor is earning in interest for purchasing the bonds. And just a quick note on these two terms. Coupon and yield can equal each other. They can be the same number, but based on pricing dynamics, they may also be different numbers. And there's a lot of nuance that goes into that. That's, again, better saved for a 201 type of class or a presentation, but just wanted to point that out. The final set of terms for this portion are optional redemption, which is a term in the loan document or bond document that discusses the idea of prepaying or paying off remaining amounts at a certain date and time. So the issuer, the municipality, when they issue bonds, will have a preset time where they will be able to refinance or pay off their outstanding obligation, and that's called optional redemption. From open market securities, that's typically there's a several years that you would have to wait before you'd be able to redeem or call the outstanding balance. But for things like a bank note or a state trust fund loan, those can be callable immediately or at any time. And then finally, the official statement, which is the offering document for municipal securities. Most of the content is what would be required by the Securities and Exchange Commission, the SEC, to offer municipal securities. It includes pertinent information about the security being offered, financial information about the health of the issuer and the credit worthiness, and then just some general disclosure documents that provide additional backup support. So that's the end of the key terms. Now I'm going to bring Brian and Greg in at this point to see if there's any questions.
Thanks, Jonathan. So our first question is, for interfund borrowings, what source should we look to for determining a reasonable rate of interest to charge?
Good question. And Brian may have some thoughts on this too, but there are some benchmark rates out there. LIBOR is the old established rate. Now there's SOFR. Is that right, Brian? Brian, I think you're muted.
No, I'm not. So we'll get the the stumbles out of the way right out of the gates here. So I've also seen many communities use something like the Wisconsin LGIP as your benchmark interfund borrowing rate. That can be more or less effective. Right now, that's not a very good bogey because that rate is so low. But it should be something that approximates the duration or term of the interfund borrowing. So you should be establishing some repayment schedule, and then maybe looking to say like treasury rates as an opportunity cost. So if you have something that's roughly 5 years, you would go look at the 5-year treasury and use that as your interfund loan rate. Essentially, I think Jonathan's point should be very well taken, that you can't, the lending fund can't go, well, this is a great way to make money, so I'm going to all of a sudden gross the rate up so I can just gobble up and make additional interest, because you have another set of constituents on the other end of that. Both parties really need to be treated equally and fairly. So a reasonable cost should actually be beneficial to both funds, in that you're earning a reasonable rate of interest and paying a reasonable rate of interest at the same time. It's probably lower than market and better than you could do by investing the money.
Great, thank you both. Our next question is, why are separate bond resolutions required for each type of project, and can funds be allocated between each type of project?
Well, I think I'll just, the first question is, it's required by statute because the state wants to sort of constrain or limit the use of bond funds, since these are obligations that go out 20 20 years in many cases. They want to be sure that the municipality is being intentional about borrowing for that amount of time. So that's why they've limited to those specific purposes. And with bonds, there's ways to allocate money within that certain purpose, but you can't move funds from one purpose to another purpose. With notes, with those 10-year borrowings, however, there is a way to reallocate funds. You can reallocate. There's no specific purposes required so that you can reallocate money within that.
I'd maybe only add that what you're describing, Greg, are the required authorizations to issue bonds without prior elector approval, right? So, you could go to referendum to issue bonds, but that's a very cumbersome process to execute a capital financing plan. So then you look to the enumerated purposes under law. And for that, then you do need to adopt those initial resolutions. And it's, you must abide by the constraints that Jonathan described. And so then you roll it all up to a single issue, but you are required to find stated purposes under law for which you can issue bonds without prior referendum approval.
Thank you both. And since the bond statutes give a lot of ability to finance core infrastructure projects, it's why we typically don't see a lot of municipal bond referendums compared to some of our school district clients that we work with. That's all of our initial questions that we've had thus far. So Brian is now going to speak specifically to the players and the process involved in issuing debt.
Thank you, Greg. We're going to talk about a few core concepts. As you're contemplating a 101 session, you tend to think about where do you see folks make the most mistakes that we have to then somehow kind of dig out of the hole later on. One of those relates directly to tax exemption. So while it's kind of a higher level concept, we do want to cover some of the basics related to the notion that municipal debt issued for a public purpose is nearly always exempt from federal income taxation. And what that means is that the holder of the debt is not paying federal income tax on the interest income that they're receiving from the issuer. Now, as such, as you can imagine, most investors are going to be primarily interested in their after-tax rate of return. And when they know they're not paying federal income tax on the interest income they're receiving, they're going to then price it at lower yields than comparable taxable investments. And that is a significant benefit to the borrower in these circumstances. So just for instance, right now we're seeing extremely low tax exempt interest rates, far below, say, even U.S. Treasury rates in some occasions. And that has wholly to do with the demand for tax exempt income. Now, let's understand that this is a privilege bestowed upon local units of government by the federal government. And as such, in order to avail yourself of it, you really have to abide by all of the rules and regulations. And also understand that there are occasions where municipal debt is also exempt from state income taxation in Wisconsin. By and large, most municipal debt is subject to state income tax in the state of Wisconsin. There are a few carve-outs where you can even issue federally taxable debt, but it is still exempt from state income taxation. Jonathan mentioned the concepts of community development authorities, redevelopment authorities, and in some cases, housing authorities. They can avail themselves of that sort of structure at certain times. So again, the privilege is bestowed upon the local units of government as long as you follow the rules. We'll talk about a few of them. Steve Broden will get into that in a little more depth because this is an area where we see folks embark on things and we have to find ways to remedy some of the issues that are created related to tax exemption. The U.S. Treasury sets forth the rules related to tax exemption. And just like in your personal life, the Internal Revenue Service is the enforcement arm of the U.S. Treasury and is the same status when it comes to the tax exempt municipal market. Do understand that while tax exemption is great and affords you lower interest rates, there are occasions where you will issue taxable debt for any number of reasons. Again, I think we've talked about the notion that some things are 201 level, but you can absolutely, as a governmental issuer, issue taxable obligations. And again, pointing to, well, what can I borrow tax exempt for? Generally speaking, any capital project that has a valid authorization under state law. If you do not issue debt that is valid under state law, you cannot enjoy tax exemption. So you do need to be careful from an authorization perspective that you follow statute. Understand also that it's not just projects that are in progress. You can also borrow on a tax exempt basis for things that you have already paid for, so you can reimburse yourself from the proceeds of tax exempt debt. Again, Steve Broden's going to get into some of that nuance because it's very important in your capital planning and cash flow. You can also borrow tax exempt for projects that will happen in the future. And there are some hooks in that, and we want you to understand some of those dynamics. Transitioning on then, let's talk about the players that you're going to engage with when you are accessing the capital markets or even bank financing from time to time, right? Who they are, so you have an understanding then of what their roles are. It's fundamental for you to understand whose interests those parties represent and how they get paid. Certainly in the state of Wisconsin, it is rather easy to kind of operate on your own. Literally, you could walk across the street to the local bank, issue a GO promissory note without any professional partners. There are always going to be occasions where you should be engaging outside parties to assist you with a transaction. Near and dear to our hearts at Ehlers is the municipal advisor. That is the role we play when we are engaged with clients. We are an independent advisor. We are not affiliated with a broker-dealer. We'll talk about that in a moment. But fundamentally, this is kind of your confidant. This is the party that has a fiduciary obligation to you as the issuer, representing your interests in all interactions with other parties that are associated with the debt issue. They're going to do a number of very, very important things and probably engaged at the very earliest time versus some of the other players that we'll discuss. So they're going to give advice on the overall finance plan, right? This is how we should think about things. If maybe you bring some cash to the table, maybe you would do some borrowing, maybe we're looking forward in time in those future projects. They're going to help you understand the finance plan. What kind of a calendar do we expect to follow? So we'll talk about process here in a moment and where people jump into those roles throughout that process. Importantly, as Jonathan talked about, building the issue, right? So you've got a project and then you need to potentially borrow for issue costs. You can borrow for interest if you need to. Again, that's kind of more of a higher level concept. They're going to help you understand what's going to make a debt issue the most marketable from a structure and sizing perspective. What are the terms that you should be looking for? We talked about that call feature. What year should we put that optional redemption feature into the structure of the bonds? And I think almost most importantly is, how do we access the capital? Your municipal advisor is going to provide you a recommendation with what is the best source of funding. Is that working with a bank through a private placement and doing a loan? Is it accessing the capital markets through what we'll talk about later being a competitive sale? Is a negotiated sale your best approach for best execution? As those decisions are made and you move forward in time, they're also going to assist the issuer with preparing those offering and disclosure documents in the form of the official statement that Jonathan just talked about. And the scope of that engagement is going to depend on how you're going to access capital. As you can imagine, there are a number of complexities associated with municipal debt from a legal perspective, and the party that plays a prominent role in that regard is a bond attorney, or often referred to as bond counsel. We're called bond counsel all the time, but we're not a firm of attorneys. We're not here to provide legal advice. There are groups of attorneys that specialize in the practice area of municipal financing, and they're going to do a number of very, very important things. We talked a little bit earlier about validity and authorization, the question around the resolutions. Well, somebody is responsible for drafting those resolutions, seeking out the notion that they're valid obligations under law, and that opinion is provided by the bond attorney. They're also going to provide a tax opinion. So I just referenced the fact that municipal obligations are often exempt from federal income taxation and sometimes state taxation. Your bond attorney is going to be an expert in tax law, and they're going to understand some of the nuance and complexities around that and give you guidance in that regard. But their opinion accrues to the benefit of both you as the issuer to enjoy that low tax exempt rate, and also the holder of the debt, so they can have confidence that they're not going to have tax issues when it comes time to receive that interest income. So fundamentally, this party is going to prepare really most, if not all, of the legal documentation. Usually they'll give you agenda language for whatever needs to go on the agenda for consideration. We talked a little bit about the official statement. There are some sections in there that talk about the legal aspects, the validity, the tax exemption, and other tax considerations. Sarah Beecher a little later is going to touch on some of the core aspects of continuing disclosure. Your lenders or the bondholders are going to want to maintain some type of a stance on you as a credit on a go-forward basis as long as they own those bonds, and you're going to be required to provide some disclosure to them on an ongoing basis. That's going to be captured in the continuing disclosure agreement that you're going to adopt. The bond attorney does represent the issuer. There is a attorney-client relationship there. But they are, as I said, giving opinions that accrue to the benefit of a number of parties. And they're typically going to be paid a flat fee out of proceeds of the issue, just like the municipal advisor. Some of you that are joining us today will recognize that you are a rated issuer. And what we're talking about here is a rating agency. We have listed the three most prominent rating agencies that provide ratings to Wisconsin issuers, or at least in that market. There are a number of other ones that you don't see as much, but are utilized by a number of larger issuers. You don't need 3 ratings. You don't need 4 ratings. Sometimes you want more than one, but beyond that, understand that there's also the ability to issue debt on a non-rated basis. But for many of you, you are rated. This rating agency is going to essentially set forth an independent credit assessment of the issuer, especially in relationship to a general obligation issue, or maybe even related to the specifics around a transaction, things like revenue obligations, covenants associated with that, protections for bondholders, et cetera, will get likely a higher rating. Understand that a better rating is going to equal a better level of capital access in the marketplace, as well as lower interest costs, right? And if you think about it logically, we've got AAA at the top, and then a gradation down into the AA category, single A category. The lowest investment grade is the BBB category. And below that, you would typically not get a rating. You would go non-rated in the municipal space. This party giving you a rating is also going to want to keep tabs on you on a go-forward basis. And they're going to do that through surveillance, sometimes annually, sometimes through a questionnaire. Sometimes they'll want to have a phone call with you, and understand that you are responsible for paying them, even though certainly they don't represent you. All right, so you're going to pay them also a flat fee out of the proceeds of the issue. All right, so some of these parties you're going to interact with leading up to the sale of the obligations. Some of them are more at the time of execution. One of those players is the underwriter, often referred to as a bond dealer. And just like a quote-unquote car dealer, they really have no interest in owning a bunch of bonds for interest income. They are in the business of buying and selling bonds. Just like a car dealer isn't driving the cars on the lot, they want to buy and sell cars and make the difference between what they paid for them and what they're selling them at. So fundamentally, they hold inventory of bonds, right? We think of bonds as being very complex. They're financial products, and the bond dealer or the underwriter holds an inventory and buys and sells bonds with and to investment customers. They have their own commercial interests. So when you engage with an underwriter directly without a municipal advisor, understand that you are unrepresented in the transaction. The underwriter owes the issuer certain duties from a suitability and fair dealing standards. Basically, they can't lie, cheat, and steal. But as far as a party that represents your interests above all else, an underwriter does not have that level of obligation. They are not a fiduciary to you. So you should be cautious because you're dealing with a party that has a higher level of information than you do. And it is in your best interest to be represented by an advisor in all dealings with capital markets. Now, the way an underwriter gets paid is a little different than the rest of the parties. They get paid a fee at closing, but it's more in the form of an underwriting discount is what we call it. So if you're going to issue $1 million in bonds and the underwriter charges you a 1% underwriting discount, which is $10 per thousand of bonds, they're going to get $10,000 of compensation. You're not fundamentally going to pay that from them to them at closing. They're going to take it out and net it out from what they give you as net proceeds at closing. So if you issue $1 million in bonds and there's $10,000 in underwriting discount, you will receive $990,000 in net proceeds. All right. And this is where your advisor also comes in. They're going to help you build the issue to accommodate for all of these fees and expenses. So we're going to gross up from your project costs and arrive at a size that allows you to pay all of these third parties that you have engaged. Oftentimes, not always, but oftentimes a debt issue has what's called a paying or fiscal agent attached to it. This is a party appointed by the issuer to assist them over the life of the bonds in making sure bondholders get paid. As you can imagine, you don't have the bank accounts as the issuer for all of the parties that own your bonds. That would be extremely cumbersome to send out principal and interest payments to 25, 50, 100 different bondholders. You're basically going to operate through a clearinghouse called the Depository Trust Company. You send them the money, they credit the accounts of the beneficial owners, so it's very seamless to the issuer. Now, understand that DTC is really a monopoly entity and they can be difficult to deal with. The paying agent takes the place of, stands in between you and them and represents you in dealing with the Depository Trust Company, and you may need to provide periodic notifications. If you're going to redeem bonds in advance of their maturity, you need to give bondholders notice. They'll help you facilitate that. They're going to be paid a flat fee at closing, some amount at closing, and then over the life of the issue, there'll be an annual fee related to their services. Okay, transitioning on, let's talk about process. We are talking about government finance, and it will be driven by process, just like every other aspect of a government operation. All right, so there are key points in time where different parties will be involved. We'll talk about that in a moment, but just to try to give you a general sense of, all right, I need to borrow money. What do I need to be thinking about from a lead time perspective? Because I can't just flip a switch or shake the money tree and all of a sudden I have it all in hand. There's a process associated with that, not just from a authorization, so a legal perspective, but also a planning perspective. And the planning aspect usually is the longest in duration. And that could be anywhere from 6 weeks to 6 months or longer. Certainly for those of us that have been doing this for a while, there are projects that I literally engage with clients on for well over a year from a planning perspective until we actually pulled the trigger and move forward with the rest of what you're seeing here. Planning and authorization, you should understand that just from the shortest time possible perspective, you're really dealing with about 4 to 6 weeks to make sure you get everything in order and that you've checked all your boxes. You then transition to the actual marketing and sale of the obligations, and this is a little more directed towards accessing the capital markets, issuing securities. So during that phase, you're going to be putting together documents. You're going to be making sure that the transaction is out in front of the audience that you're seeking. And you really need about roughly 4 to 8 weeks to let that unfold. Longer for more complex debt issues, shorter for, say, just a very plain vanilla general obligation debt. Once you sell the obligations, you've set the rates and terms, you've executed your final resolution or your indenture. Now you're going to transition towards closing, and that's going to take roughly 2 to 4 weeks. And why do you need that long? There's a bunch of paperwork that needs to get signed and certificates that need to get executed. So you take your time to get all that in hand. The attorneys are the ones that ask for all those signatures, and they bring everything back together. They review all the documents. All right, everything's in order. We can close, right? And we've already established our closing date, and on closing, you exchange bonds for cash. You get your proceeds. And then finally, as you're well aware, selling bonds or issuing bonds is a lot like buying a home. It's a lot of work to get through on the upfront side of things. And then you close and you feel great. And then you realize, now I've got something to do for the next 20 years. I got to take care of this thing. Make sure it's clean, make sure the exterior looks nice. I'm going to want to actually maybe get rid of it someday. It can't just fall over. So the debt administration aspect is extremely important and spans the life of the debt. All right, let's slot in our players into our timeline here and understand who needs to be doing what. The issuer is involved throughout the entire process. Obviously, that's you, and you need to understand generally where to get people involved. So the sizing and structuring, how much do I need to borrow? What should the debt look like? Jonathan talked a little bit on the front end about managing tax rates. Your advisor can help you contemplate the structure of the debt. It's not a consumer loan. It doesn't have to be just the same payments every month or every year. You have some flexibility and latitude in structuring your debt to potentially mitigate the upfront impact, not just kind of layer on your existing debt portfolio. They're going to help you establish a calendar. What does the timing look like as we get through the authorization process and the actual sale of the obligations? Concurrent with that, oftentimes you're also engaged in discussions with the bond attorney or bond counsel. You're going to need to set in place and have discussions around legal authorization. They want to understand the nature of the project and any kind of extracurriculars around that. Do you have agreements with private parties, et cetera, et cetera? They want to early in that process understand the tax status of the debt. It's going to drive a lot of the transactional documents. Sometimes you need some formal studies or reports to authorize debt. And ultimately, if you need referendum approval, you need a lot of lead time to be able to craft questions and make sure you've issued bonds validly. All right, now we're getting into some of the meat here and the important aspects. And the bond marketing and sale component is extremely important, primarily because you're putting together a regulated securities offering document if you're accessing the capital markets. And again, you're going to do that through an underwriter who's responsible for distribution of the bonds to investors. So there may be more or less players involved in preparing an official statement, and it could be a more or less involved exercise as well. The nice thing about accessing the capital markets is that's a place where you can achieve a fixed rate financing for terms 30 years and sometimes even beyond, depending upon what you're trying to accomplish and what's going on in the marketplace. And in those occasions as well, nearly always your offering document is going to take the form of that official statement. And we've got you kind of the caption and the opening and the intro from the cover page of this particular official statement. But they can range anywhere from 60-ish pages up to 200 or more, depending upon what you're trying to accomplish. All right, I talked a little bit about method of sale earlier on. We've got a next couple slides speak to that specifically. And this is really where your advisor plays an integral role in trying to achieve best execution for you. One way to think about issuing bonds is really not a lot different from how you, say, go out and hire construction companies for projects, and that's through kind of a bid arrangement. So that's when we're talking about competitive underwriting. The debt issue is really sized, structured, the offering documents put together, the terms are really set forth at the front end, and then the bonds are put out to bid through competitive sale. On the day of sale, underwriters submit their proposals and they are binding. Your advisor will tabulate them, and essentially you award to the lowest interest cost proposal. Very transparent, very straightforward, works extremely well for things that are well understood in the marketplace, like general obligation debt, essential purpose, utility revenue obligations, say sewer and water, that are good credit. And once in a while, you'll also need to evaluate, do I need to go through a negotiated underwriting? And that's where you should be working with your advisor to pre-select an underwriter who will work with you to market the obligations to investors. And why would you want to do that is you need somebody who knows they're effectively going to get paid to engage their sales force and get in front of investors and show them that transaction and tell them the story and get the interest going, right? So this can be very effective for debt that has very unique features, something that's really not, people aren't going to be as interested through a competitive sale. If it's a new credit, something you haven't done before or that is really untested in the marketplace, or if you have a really kind of challenging financial profile as the issuer or your enterprise, or if there are very difficult market conditions, you really want that partner standing by with their balance sheet available, because in the event they can't sell all the bonds, they'll put the rest into their inventory and sell them later. And so this can be very valuable. But again, you want an advisor providing you the recommendation and standing by your side in both of these scenarios. All right. Also, certainly bank financing is extremely common, especially in the state of Wisconsin, for any number of reasons. We call that a direct placement. You're going directly to the lender, and you're really doing a loan. It gets back to the notion that we have different names for the same thing, debt. And in these occasions, no official statement is required. There may be some level of disclosure. The lender's going to want your financial statements. They kind of want to understand the terms and conditions. They may want to see other things. But this can be very attractive for small and infrequent issuers, issues with small size. Once you start to layer on fees, smaller issues become kind of cost prohibitive from an all-in cost standpoint. But again, your advisor should be assisting you with evaluating these options. And they're likely going to look at what is the issuer's all-in cost for me to be able to give you a recommendation. So bank financing versus capital markets, are there some unique features that would lend themselves better to bank financing? Your advisor should be assisting you with that. And then finally, and probably most importantly, just because you go to the local bank and get a loan for a GO promissory note, it does not allow you to somehow circumvent the statutory process that is set forth in law. Working with banks still requires valid authorization under law. You have to follow all the rules. And then also understand that there are a number of state revolving loan programs, and I would include the state trust fund loan program in that. And then I'm sure many of you also access the environmental improvement funds operated by the state of Wisconsin through the DNR and Department of Administration. Those are most specifically used for, say, sewer and water projects, whereas a state trust fund loan can be used for many, many projects and affords you fixed rate financing for terms up to 20 years. USDA rural development can also be a source of financing. We most commonly see clients use that when they need very long fixed rate structures so that there's not as much of an impact. So Jonathan talked about the potential for 40-year term. USDA is an entity that will buy loans and fixed rates for 40 years. There aren't many entities out there that would do such a thing, but a lot of times there's also a grant associated with that. So it makes it a very attractive option. Then we'll just talk about sale and closing here briefly. At the time of sale, that is fundamentally where the bonds are priced and the rates and terms are fixed. At that point in time, if there has not been prior authority delegated to others to execute transactional documents, there'll be a final resolution that will come before the governing body. And once that's adopted, you really have a contract in place for purchase and sale of the obligations. You'll also then prepare a final official statement if you've been accessing the capital markets. And then you move on to closing. And again, as I mentioned before, no different than any other aspect of when you get a loan in your personal life. Closing, you exchange the note or the obligations for the net proceeds, net of all of your costs. Certainly, you can invest the funds if they're not needed for some period of time. There is, some things that you should be aware of in that regard. And again, Steve Brolin's going to pick up on those tax aspects when you're issuing tax-exempt debt. All right, we're going to pause for a moment and delve into another Q&A. And for that, we'll bring Greg back on. And Jonathan.
Thanks, Brian. So our first question we have is, are there any time limitations on borrowing for past or future projects? So certainly talking here about reimbursement requirements and then requirements for borrowing for future projects as well.
That is great foreshadowing, and I'm not going to answer that because Stephen Broden is going to get into some of the high-level detail on that, not too far in the weeds, but enough to answer that specific question. And it is a great question because you see a lot of mistakes made in that context.
And then another question about rating agencies. So do the rating agencies update your rating throughout the entire term of the debt, or what will cause your rating to change over time?
Well, there are many factors that could cause your rating to change over time. I think maybe the first thing I'll say is once you've sold the bonds and they have fixed rates, a change in the rating does not change the interest cost that you're paying on that debt. You have locked in. So even if you were downgraded, it's not going to increase the cost of your existing debt that was previously rated. And yes, they are going to want to monitor you. Oftentimes it's annually, not always. They may just ask for brief updates periodically through questionnaires. And then once in a while, if something fundamentally changes, they may say, all right, we want to get on a call and here's the questions we want to ask. Jonathan, I don't know if you have anything to add to that, but generally speaking, you're going to get some level of inquiry on an annual basis.
Great. No, thank you. That's good insight. So thank you both, Jonathan and Brian. That's a good background in terms of the process and the key players and kind of the planning elements that go into debt issuance. When we look at what happens after you've secured the funding, you've received the proceeds, you've gone through closing, what other obligations or responsibilities do you have as issuers of municipal debt? That really falls under the general category of debt administration. We're going to speak to kind of two of the fundamental areas of ongoing debt administration. First, we'll discuss arbitrage monitoring, and then second, we will discuss continuing disclosure responsibilities. So first, we'll discuss the arbitrage, and we'll bring on Stephen Broden, our arbitrage managing director, who will give us a background in arbitrage and speak to some of the specific requirements that issuers have post-issuance after the bonds have closed. Welcome in, Stephen.
Thank you, Greg. Really appreciate it. So first, what I wanted to do is just say, well, what is arbitrage really? So earlier in the presentation, Jonathan started this off by explaining that when you structure your tax-exempt financing, it's going to have a yield associated with it. That yield, if tax-exempt, is going to be favorable, as Brian pointed out, or presumed to be favorable. So what happens is you're going to issue, right? You're going to receive the money from that bond issue. And then if you can't spend it right away, you might invest it. So if you invest it in taxable securities like people often do, even the LGIP, you're going to have a position where you can create arbitrage. Arbitrage is basically looking at the two different markets, the tax exempt and the taxable market. And your advantage is if you're issuing at a lower rate and then you can invest at a higher rate, that's where you create arbitrage. So more simplistically, this graph represents arbitrage over time. The blue line horizontal, that's the yield that's created at the closing of your bond sale. It doesn't change over time if you have a fixed rate issue. But what you'll notice is in this particular example, at the very beginning, the interest that you're earning on your investments is lower than the bond yield. And so that gray area is actually what's called negative arbitrage. Then after a period of time, the investment market has shifted and created that orange shaded area. That is what's called positive arbitrage. And you'll notice that the graph doesn't represent the amount, right? It doesn't tell you how much negative and how much positive. But in a simplistic way, you can see how the positive and negative arbitrage changes over time. That's what we're trying to key in here. Now, this was brought up earlier on a couple slides, but one of the key elements with arbitrage when you're structuring an issue for the intent of reimbursing prior expenditures is you have three rules that you have to apply by. So the first one is you have to timely adopt your official intent. You also have to make sure that the funds allocated are done during the reimbursement period. And you have to make sure that the specific expenditures are allowable. Okay, so the official intent. So this is normally done by resolution. This is done during the planning phase. And what you're doing is you're going to declare an official intent within 60 days of the original expenditures for the project that you want to reimburse. So that's key because the general description of the projects means that if you have multiple projects, you want to be very careful about what you're going to reimburse. Is it for bonds? Is it for notes? Be really clear, ask lots of questions during that process. Also, the document does have to have the maximum principal amount of debt that you're planning on issuing. And you have to actually have a reasonable expectation that you're going to reimburse by way of that official intent document. So the reimbursement period, you have to allocate no later than 18 months after one of 2 days. One is the original expenditure date, or the second one is actually when the project is placed in service or even abandoned. The allocations can't be made more than 3 years after the original expenditures occur. But of course, it's the IRS, so there are exceptions to the rules. And so if you are a small issuer, which I will define more later on in my slides, the reimbursement allocation dates will change. Okay, so what is normally considered original expenditures? Well, definitely your capital expenditures. Some people will look at cost of issuance. also extraordinary working capital expenditures, which are not common, and then grants. So where are some of the exceptions to these reimbursement rules? The first one is the de minimis rule. So if your original expenditures that you're going to reimburse do not exceed $100,000 or 5% of the debt proceeds, you still have to spend those monies with due diligence, and track everything from that perspective, but you don't have to further report on those amounts. On the flip side, if you're going to look at preliminary expenditures, you can cover up to 20% of the total issue price with original expenditures that are expected to finance either a project or projects. And then I did note this earlier on, but there is an exception for small issuers. So if your municipality is going to issue or expects to issue no more than $5 million of aggregate debt issues during a calendar year, what that would do is it actually would change the reimbursement period. So instead of the latest reimbursement allocations being made at the 3 years at the far end, it's actually unlimited. Although I caution you, if you're going to be a small issuer and plan on reimburse, you still want to make sure you're discussing what the impact is with bond counsel, your municipal advisor, maybe your rebate team. So some general considerations for arbitrage. So of course, during the planning phase, you want to make sure you're looking out for opportunities to do those reimbursement allocations, and you want to make sure you timely adopt your official intent. You also want to make sure that you understand what your spend down duration looks like. If it's a larger issue, you might be looking to take advantage of the arbitrage spend downs. But generally speaking, you're going to want to make sure that you're going to spend more than 85% of your money within the first 3 years of the financing. You also want to make sure you understand the financing complexity. I know this was brought up earlier as a question and a discussion point, but if you're issuing notes, the way that you issue notes for projects is different than bonds. With the state statutes being very restrictive of bonds, you want to make sure you're very careful with what you're going to put into the financing. And also just how complex the financing is generally. If it's a general obligation bond versus like a revenue bond, you might have more complexity with the revenue bond. And then you want to make sure that your project expenditures and your debt service payment accounting is in check. So the IRS does require that you keep work papers of the entire spend down of all of the bond money as well as any interest earnings. So at closing, you want to make sure you update your draw schedules. Things might change, especially with post-COVID. We're seeing construction projects and the timeliness of those change with the cost of materials rising and people actually not having as much time on their hands to assist you with your projects. You want to make sure that your investment policy is up to date, that you have a strategy and preferably a portfolio. That way you know what money you're earning, because it's not a bad thing to earn money as you spend down your bonds. And then you want to make sure that you establish an arbitrage tracking plan. So, that's why I mentioned that, because depending on the size of the issue, the rules are different. So, of course, on a post-issuance basis, the biggest thing that you want to be doing from an arbitrage perspective is you want to conduct your accounting of not only the reimbursements, but also the arbitrage cash flows that occur after closing. You want to make sure that you're maintaining a tracking log of the arbitrage dates and as well as the allowable yields for your different investments. You want to make sure that you complete internal or external arbitrage reporting. So I think that's going to be dependent on the issue size. You might look at things different if you're issuing $1 million note and it's the only thing you're doing that year versus a bond that you might issue that's $9 million and has a number of projects associated with it. You also want to take a look at what your investment performance is doing as compared to the bond yield, as the investments are going to change from time to time. And then you want to make sure that you're complying with all the state statutes. So this was brought up earlier, but there are different rules for how you structure and how you spend a bond versus the notes. That might lead to a number of discussions if you need to reallocate monies from a note to a bond, or if you have a bond and you can't spend all the money, you want to make sure you understand what your next steps are. I'd say your next step is to talk to bond counsel. And then also the state statutes have a rule for premium on debt service. You want to make sure that you're establishing all of that excess interest in the debt service and kind of separating it out from your normal debt service so that you're not holding on to that premium deposit. And then the last thing I want to cover, although it doesn't happen all the time, is you want to make sure that you're avoiding the private use limitations that the IRS establishes. So some of the things that might be of concern are how you have your facility uses. So, with COVID, your facility use considerations may have changed. If you plan on changing the use of a government facility, perhaps renting it out to a private organization, make sure you talk to bond counsel. You also want to make sure that if you plan on selling any of your land that was acquired with tax-exempt bonds, you need to talk to bond counsel. If you have any management contracts, especially those associated with any jail facilities, I definitely recommend talking to bond counsel. And you also want to make sure that if you are developing a facility that's in close approximation to private businesses, such as an office building with a government parking garage that's maybe close to a convention center, this is just an example. If you run into a scenario where that parking garage has got too much private use paying for it, then you might have a problem there. Again, anytime you have private use concerns, you want to make sure you talk to bond counsel first and make sure that it's not going to create private use. Now that we've went over a high-level look at arbitrage, I'm going to turn it over to my colleague Sarah Beecher to discuss continuing disclosure.
Great, thank you, Stephen. So assuming you've issued securities, you will have now entered into a continuing disclosure agreement, or a CDA, at the time the bonds or notes were sold to investors. Now your investors will want to monitor you as that creditor. Your CDAs will require regular posting of certain information on at least an annual basis to a central information repository known as the Electronic Municipal Market Access website, or EMMA. This repository is a service of the MSRB. Also note, if a bank is a lender, they may have disclosure requirements that they may need you to abide by. These disclosures will be sent directly to the bank itself and not filed on EMMA. So it's important to review all bank loan terms to identify if the debt issue has any of these reporting requirements. The most common disclosure categories are either full disclosure or limited disclosure. Full disclosure requires posting of the annual audited financial statements, along with the updating and posting of certain operating data and tables contained in the official statement for the bonds or notes that were issued. Limited disclosure typically only requires the posting of the annual audited financial statements. And the difference between full and limited disclosure categories depends upon the amount of outstanding debt that an issuer already has subject to disclosure reporting. So more than $10 million in outstanding debt will put you into the full disclosure category. Both full and limited disclosure do require posting of event notices, which we will go over in a little bit. The required operating data that is to be prepared and filed will be laid out in the continuing disclosure agreement that is signed and executed with each securities issue. These requirements can vary depending on the obligation type and pledged revenues of the issue, but also could vary depending upon who prepares your official statement, as each preparer uses a slightly different format to compile information. Some examples of the information that could be required are valuations, current property valuations, debt, tax levies, and employment trends. So along with posting annual financial information, there are 16 required events that need to be filed when these do occur. So the filing must be done within 10 business days of occurrence. This is really not a great amount of time, so it's important to keep these events in mind and communicate to your municipal advisor or bond counsel when these do occur. And instead of going through each event, I will make note that the most common events that we see are principal and interest payment delinquencies, securities or bond calls, and any type of rating change. Rating change notices need to be filed not only when an issuer's rating changes, but also any bond insurance rating change. And typically you will receive a communication from the rating agency when and if a rating does change. So in February of 2019, the SEC added 2 new events. Event 15 is the incurrence of a financial obligation of the obligated person, which is now you, the issuer, if material, or agreement to covenants, events of default, remedies, priority rights, or other similar terms of a financial obligation of the obligated person, any of which affect security holders, again, if material. So material means there's a high likelihood that a reasonable investor would find the obligation important and that it would impact their decision to buy, hold, or sell a bond. Now, event 16 is a default, event of acceleration, termination event, modification of terms, or other similar events under the terms of a financial obligation of the obligated person, any of which reflect financial difficulties. So why were these additional events added? These issues are not automatically disclosed to EMMA. Investors want to be made aware if you enter into any of these obligations and whether or not the obligations may contain priority rights which they may not enjoy. So just a couple examples of some of the obligations that should be disclosed under Event 15 are the State Environmental Improvement Fund loans, so your Clean Water Fund loans, Safe Drinking Water loans, USDA loans, privately placed bank notes, and material capital leases. A few factors you may want to consider when assessing materiality and whether or not an obligation should be filed. You can look at the source of security pledge for repayment, the rights associated with the pledge, either senior or subordinate, the par amount of the obligation, and any terms that could affect security holders, such as covenants or priority rights. We just spoke to required disclosures under a continuing disclosure agreement, but issuers can also provide voluntary disclosures as they see fit. So EMMA is set up to properly categorize these voluntary filings so they can be easily made. Some examples of what could be filed are any type of financial impact of COVID-19 or COVID-19 impacts on the security attached to a debt issue, any type of important interim financial data, and also any privately placed debt for an issuer not yet subject to events 15 and 16. So an issuer is not subject to events 15 and 16 until they enter into a continuing disclosure agreement dated after February 27th of 2019. So if you've not issued securities since that date, you are not yet subject to the 2 new events. So you can be proactive and let the market know of any new financial obligations you may have. Please note, please exercise caution if and when you do make these disclosures, as making a disclosure filing or posting information on your website is considered communicating with the market and is subject to securities disclosure regulations of the SEC. And we always recommend you consult with your bond counsel and municipal advisor prior to making any of these filings. So that's really all I have for you today in regards to continuing disclosure obligations. We are going to hand this back over to Jonathan, who will close us out.
Great. Thank you, Sarah. And thanks everybody for following along here. Just wanted to wrap up with a few closing thoughts. Hopefully it's clear now that fundamentally there are a number of different things to consider in the run-up to issuing debt, in the structuring and actual sale process, and then throughout the life of the debt. And hopefully that's a bit clearer now. I also wanted to just mention that issuing debt, when we're talking about decades of amortization and all of the management that goes into that, is really a legacy for many municipal employees or elected officials. And so all the proper diligence and steps should be taken throughout the process. And luckily, there are plenty of professionals to help along the way from beginning to end. So always feel free to reach out and seek guidance from your professionals as you consider debt. So now we're going to take any final questions. I'm going to bring everybody back into this, and then we'll wrap up.
Thanks, Jonathan. We do have a couple of questions, a couple here for Stephen. So should investment earnings be tracked on a project basis or for the proceeds of an entire issue?
That's a really great question. I think it depends on how you want to track the investments versus some form and function there. Sometimes what people are looking to do with the interest income earned from a set of projects is to put them towards a specific project. Versus if you feel like you have to do it, I think that is going to depend on maybe the way that you planned out the debt financing. So from a simplistic perspective, the IRS says as you earn income, regardless of which project it's associated with, you have to track it for arbitrage purposes. So again, I think that the form and function of how you do that is more of an internal accounting. And I think if you do that at all, I find that to be a very reasonable decision. The fact that you are doing that at all is a good thing.
Great. And kind of a similar follow-up question to that one. Does the 85% spent within 3 years of issuance apply to each project within a borrowing or across the total issuance?
It's across the total issuance. And so that does give you some leeway with how you spend your money. And it's 85% of the net proceeds, which does also impact things because you might have reimbursements, and those are going to be really beneficial for you to meet the 85% rule. But there's really 3 rules to that component. One is you have to obligate yourself to spend enough money at the first 6-month window where your bonds did not perceive to be as issued early. You have the 85% rule generally at 3 years or 5 years if you get additional sign-off for an extended period. And then the third part is it's all about spending the rest of the money with due diligence. So if you still have 85% spent at 3 years and you got that 15% lingering, you don't have to rush out and spend it right away. What the IRS is trying to say is, okay, you've spent most of your money. Now spend that last 15%, preferably within the 5-year mark. And if you still have money left, as we brought up earlier, and you can't find a use for it, it's very imperative that you reach out to bond counsel, your municipal advisor, and your rebate person, and you talk about what the next step is. If it's a bond, that's going to look different than if it's a note program.
And kind of a final wrap-up question, Stephen, on just kind of managing arbitrage from the issuer standpoint. So if I track investment earnings and spend proceeds, within the permitted timeframes for each particular issue, will there really be any arbitrage concerns to address?
There may not be. So there's what is very obvious and in front of you, and then there's what's kind of behind the scenes. And so on the forefront, if you're an issuer who's just programmably tracking the spend down of your bonds or your notes on a proactive basis, and you can isolate exactly what money you received and how much interest you earned, and you can prove that you spent it, that's what the IRS is going to ask for in an audit. Now, that doesn't mean that something comes up that you didn't consider or that you didn't take in consideration all of the elements, right? So like if you can't spend a bond, again, that's going to be different than if you can't spend a note. And if you have additional revenue sources coming in for projects, did you apply the bond proceeds from an accounting perspective consistently? Either you specifically trace those expenditures, or you did like first in, first out, or you did last in, first out. Like, what accounting principles did you use? If everything you believe is in good order and you have tracked your arbitrage internally, more power to you. If you did that and you still want third-party validation, that's what people like me are here for. And oftentimes we're the most beneficial party when you get into an IRS audit, because we know all the answers to what the IRS is asking for. And again, if you do your own reporting, the IRS is still going to ask you to either give them the documents, or they're going to ask for you to give a report from someone else. So you can do it yourself. You may not have any arbitrage concerns, but at a minimum, never hesitate to ask questions of your advisor team.
Thanks, Stephen. Those are some good tips. I think it's always important for issuers to remember that arbitrage is really something that can be managed with some good record keeping and attention to detail in terms of investment earnings on bond and note proceeds, and keeping track of how those project funds are spent. Those are two fundamental tenets to successful arbitrage management. So thanks for sharing some of your insights on that. One question for Sarah in terms of continuing disclosure. If a wire is sent to DTC prior to the principal and interest payment due date, and DTC sends a notification stating that the payment was not applied correctly, is the payment still considered late, and does that trigger a required disclosure?
It's a great question. Most of the time, we would not consider that a late payment. You did your due diligence, you sent the money properly to DTC. It may have been a miscommunication on DTC's end or a processing error on their end, but most of the time we would not consider that a late payment, and we would not file an event notice in that circumstance.
Greg, I've actually got a good practical. I have a client who ran into a similar situation where their own bank that was initiating the wire put the wrong instructions in. So the issuer did everything that it was supposed to, right, to get the money to DTC in a timely fashion. And DTC will not float you, right? They're not going to send the money out and wait for it to come in. And the reality is, then we kind of have to wait to see how the market absorbs that by and large. And the practical implication to the issuer is that, sure, you have to make that initial determination as to whether or not you file an event notice. But then out of an abundance of caution, you would typically make a statement in your official statement for maybe the next 5 years to that effect. And you would give some narrative description as to what actually happened, because underwriters are going to be able to potentially see these things occurring, and they're going to make inquiries. And if you don't put that information in there, they're going to maybe not bid on your bonds competitively, or otherwise compel you to make that statement in any event. So these things do happen, and it's good to engage the people around you to make those determinations so that you set yourself up for success for the future.
Good points, Brian. That's a good example. Another question for either you or Jonathan. If I'm planning a project to start construction in 2022, can I borrow the money now to take advantage of more favorable interest rates?
I mean, the quick answer is yes. But as we are wont to do, the follow-on would be, it depends, right? So there are facts and circumstances that need to be paid mind to. And that's also where even somebody like Jonathan or I might pick up the phone and call Stephen and make an inquiry with him quickly on, all right, that's fine. What's the plan for investment of those proceeds? What are the spending considerations? Will we meet the small issuer exception? And maybe we don't have to be as concerned. And maybe once we gather some information, then we approach the bond attorney to close the loop, so to speak, to see if that impacts their considerations from a tax exemption perspective. They're always, and they being the bond attorney, they're going to send you a questionnaire that you're making you're going to make certain representations with respect to your expectations of the spending of proceeds, and it's reasonable expectations. You don't have a crystal ball. And you may answer things in there that raise the alarm bells for them. And then we just have a quick discussion to figure those things out. Jonathan, I don't know if you have anything to add or other examples in that regard, but it can be figured out.
Yeah, and I would agree. I think it depending on the nature of the project, that could impact what type of debt you would want to take out, whether it be not notes or bonds, and then that could have an impact on whether that's an advisable thing to do at that time.
Yeah, and given where rates are at, Greg, those are the conversations we're having with clients when they have a project happening right now or they have a refinancing opportunity. Oftentimes we're talking about, are you doing anything next year, right? So we are kind of at what I would call an absolute low point in rates, not the absolute point, but it's a very favorable interest rate environment. And these are the kind of things that you should be considering. Now, understand that if you're borrowing for a project now that happens in the future, you don't get to defer the payment on the debt until the project is placed into service. So there's a lot of planning that should be going into borrowing for projects in advance of them actually occurring.
Those are good points. I think a related question we get from a lot of communities is, can I borrow for multi-years worth of projects in one borrowing to cut down on the number of debt transactions that are incurred? And it's really the same kind of principles apply. It's making sure that you're still doing the planning, understanding the spend down provisions, investment earnings. So you can certainly plan ahead and try to finance multiple projects at once if they cover a couple construction seasons. But still understanding that you still have to abide by a lot of the fundamentals and the principles that we've been discussing on our panel today to make sure that you're exercising good financial planning and also adhering to good debt management, particularly from an arbitrage standpoint.
Yeah, maybe I would just close out that little discussion with, it's the job of your advisor to help you also contemplate the marketability of your debt issue, right? So if you know that for the next, say, 3 years, I'm going to have $2 million of the projects, you might be better off to issue $6 million in debt in a single issue. Number one, you're avoiding transactional costs for each individual issue. Than you are for the three $2 million issues. But now you have a larger issue, larger maturities, and it makes it more attractive to the underwriter and investor community. So you may get better execution as a result. You may pay a lower underwriting fee on a percentage basis. You have larger maturity sizes, so that attracts a different set of investors than very small maturities. And there are other aspects of that. So these are all very important conversations. So I like to engage clients with this conversation so I have a sense of what's going to occur over the next few years. It also informs me on structure. Do I need to be considering things that are going to happen in the future in the context of this particular debt issue?
No, those are great points, Brian. I think we all would agree that the more information we have and the farther out that we can look in terms of helping communities plan for capital needs, the better the financing plan will be and the execution will likely follow. So all good points to remember when you're treating debt issuance, not just for your immediate capital needs, but looking ahead to the future as well. That's all of the questions that we have for this section of the Q&A portion. I want to thank everyone on our team and on our panel for sharing their insights and their areas of expertise today. Please note you can review a copy of today's presentation and a recording of the session will be posted to your virtual attendee hub for future reference and use. And remember, because we're always interested in learning about ways we can help make our virtual experience more dynamic and deliver content that's valuable to you, we ask that you fill out a brief survey for us. If you refresh your browser, you'll see that a survey button will come up. You can participate in the survey that way, or we will be emailing out a link to a survey separately and encourage you to provide that feedback. So we always value any insight that you can share. So we encourage you to utilize that survey when you have time. We do hope that you'll consider joining us for our final session. If you want more Ellers in your life, and hey, who doesn't? Our final session is on June 9th. More Than a Checkbook, Banking and Treasurer Management Best Practices, which will be featuring our investment team here at Ellers. So thanks again for joining us today. Thanks again to our panel. Thanks for submitting your questions. And we look forward to having you join us on our next session. Enjoy the rest of your day.